One of the main benefits of property investing is that you can leverage OPM, other people's money. There's very few asset classes available where you can get debt from the bank in order to increase your stake or your wealth. For example, you can't really go to the bank and get money to buy stocks or Bitcoin, and it's really hard to get money from the bank to start your own business. And usually the risk premium that comes with that makes the debt really unattractive. But if you have good affordability, a good credit score, and you've got a property that has got good value, it's pretty easy to get a loan from the bank. Now, when you're working with private investors, you also have the option to loan money from them. And this tends to be a cheaper option than giving equity away. Equity is one of the most expensive things that you can give away, because not only are you giving away control, but you're giving away profit share. Where a loan agreement is a way in which you can still provide your investor with a decent return without having to give up too much of the pie. I educate people to reach financial freedom through property through cash flow positive investments, specializing in the low income multi-let residential market. So let's talk about loans. What is a loan? A loan is a credit vehicle where money is lent to another party in exchange for future payment of the principal amount with certain terms and conditions. Now, there are three main components when looking at a loan. Number one, you have the principal. Now, principal is a jargon word for the actual amount that you have borrowed. So if you go to the bank requesting a R1,000,000 loan, the R1,000,000 is your principal amount. Then you have interest. This is what's in it for the bank or the investors. When they give you money, they attach a certain premium to it, an interest premium, and that is the additional cost added to the principal, representing the cost of borrowing. So you might loan R1,000,000 from the bank, but the bank is going to put R1,000,000 of interest on top of that. So you're going to, in effect, pay the bank back R2,000,000 over a 10, 15, 20-year period, depending how long the term is. So the bank is willing to upfront give you the R1,000,000. In exchange, they know they're getting a future amount bigger than what they gave you. That's the whole point of a loan, right? You give money to someone at an interest premium and they have to pay you back, and that is what you get. That's the cost of borrowing. That's the benefit to the borrower. And then you have finance charges, so additional fees or charges added by the lender. Now, the bank will often ask you to pay a bond registration fee, which is 5,000 to 10,000 Rand, and it's just to cover the administrative cost of registering the loan. So those are examples of some ad hoc finance costs. But your main components is the principal amount, what you're lending, plus the interest, and those two combined equals the total amount of money that you will owe the bank or the lender. Now, you have various types of loans, and these different loans can be used for different investments, but they also come with different terms and conditions. Now, number one, you've got your secured loans. These are the loans that are backed by a physical collateral. So a property or an asset or a car or a watch, something with inherent value that the bank can repossess should you default. Now, this is a very secure loan to the bank, because if you default, they'll just take the asset collateral and repossess it to recover their capital. So you tend to get really good terms from the bank when you're going for a secured loan, because the risk to the bank is minimal. And then you have unsecured loans. This is where you have no collateral to back up the purchase. So you might be lending money from the bank to start your own business, but you don't have a car or a house or any paid off asset that you can use for collateral. So what the bank then does is they look at your credit worthiness and then make an assessment. And if they think that you're a relatively low risk candidate, they might lend you the money, but it's going to come at a premium cost, because for the bank, they're taking a risk. If you default, your business isn't worth anything. They can't repossess your business and try and sell it on the open market. So for them, it's quite a high risk. Then you've got commercial loans. Now, this is, for commercial purposes, when you're expanding your business, making purchases, when you go into commercial real estate, for instance, which is something that I've recently gotten into, you go for commercial loans, which are a lot more expensive than your normal residential loans, because the bank's taking more risk, right? There is more risk in commercial, retail, and industrial property, and therefore the bank will add a risk premium. So they'll either reduce the term or increase the interest rate, or sometimes they'll do both. And then you've got personal loans. This is used by individuals to cover personal expenses, education, home renovations. Sometimes people use this to go and travel or buy cars. Personal loans are very, very expensive and come with a massive premium. Now, the way you can structure your loan will have a big impact as to how much your monthly payment will be, and will have a huge impact on your cash flow. So you can have a one-time lending facility from the bank where they give you access to X amount of money, or you can have a open-ended line of credit, which is essentially like an access bond where you get access to a certain amount. You can pay it off, but then you can always access it again, and you're able to refinance for future use. I did a YouTube video a while back where I spoke about how you can structure the terms with debt in a way that can change your payment behavior. So let's jump into that video. I'll show you 3 different ways in which you can pay back the debt and what the impact will be on your cash flow.
Let me show you a quick example. Okay, let's say that you wanted to buy this this block of flats, and you needed 1 million capital injection. So you needed a loan from an investor. The loan that this investor's asked for is 12%. And they've said they want you to pay it over 10 years. Okay, now the payback structure. This is where it gets really interesting. They've told you their terms, but now we can structure our monthly payment back to the investor to suit our needs. Okay, so scenario 1, what you're going to do is you're going to pay the monthly interest and the capital. Remember that there's an interest portion and there's a capital portion when you're paying back the bank. When you're paying your investor back, you're also paying an interest and a capital portion. Okay, so if you were loaning R1 million at a 10% interest rate over 10 years, that would be your total monthly payment. That would be your interest plus your capital. So if you loan R1 million in the year 2020, by the end of 2030, you'll have paid 14,343 Rand per month for those 10 years. Okay, so every month you'll be making those payments. By the end of 2030, you will owe the investor nothing because you've made your payments every single month. At the end of 2030, you get to walk away with the property. You have no more debt. Okay, that's the most common and the most standard way, and that's how most of the banks work. What you can do with the investors, you can change this slightly. You can say to them, I would like to pay you monthly interest, but the capital portion at the end. Okay, so I'm only going to be paying you the monthly interest. I'm not going to pay you the capital amount back, which means that your monthly payment would now be 10,000 Rand, not 14,000. So again, in year 2020, you take R1 million loan from the investor. You pay them 10,000 Rand per month every single month for 10 years. At the end of 2030, you've paid all your interest off. Now all you have to pay is the actual capital of R1 million. What that does is it buys you 10 years worth of time to raise your capital of R1 million to actually buy the property. So what you're doing in scenario 2 is you're reducing your monthly burden. You're reducing your monthly payment from 14,000 to 10,000, which makes your cash flow more attractive. And you're buying yourself 10 years to be able to raise the R1 million that you need to be able to pay off the capital. The third strategy, and probably the most profitable for us as investors, but the hardest to find, is the end capital and interest. Okay. So here, essentially, you're paying nothing every single month. Now, how this would work is in 2020, you loan R1 million from the investor. You decide to pay nothing for the next 10 years, and at the end of 2030, you're going to pay the capital amount back, which is the 1 million, plus you're going to pay the interest of 1.4 million in one lump sum. Okay. Now, if you can get an investor to loan you money at that condition, I would say go for it. It's a no-brainer. I mean, that's great. That basically means you don't have to pay anything back on a monthly basis, which means you can save and you can, put that money aside for when you actually have to pay off with the full amount. The most common one that I'm seeing is usually the middle one, where you're just paying the interest and you can pay the capital at the end, or obviously scenario 1.
Now, with debt comes risks. And if you do not know how to use debt, you might fall into the trap of using bad debt. Now, bad debt is when you buy something that is not an asset, that doesn't put money into your pocket, and that is unable to service the debt, which means that you, using your salary, have to service the debt. When you're buying assets, you're using good debt. If I use debt to buy a property where the rental income can easily cover the bond repayments, all the expenses, plus there's a little bit of profit left over in my pocket, that's a great use of debt, because in that scenario, the more debt that I get, the more my cash flow will grow and the more my profit and wealth will grow. So as long as you're using debt to buy good income generating assets, debt is good. But if you use debt poorly, you buy liabilities, you travel, you use it for luxury and lifestyle purchases, that's not an asset, you're using debt poorly, and therefore it's bad debt. Other risks that you want to look at when you're looking at loans is number one, credit risk, right? The borrower may default. You, as the person lending the money, may default, especially if you have a poor credit history or financial instability. And that will then make you seem very unattractive to future lenders. If you default and you get blacklisted or your credit score goes down, it's going to be almost impossible for you to get future debt at competitive rates. Interest rate risk, right? We've seen it now. In 2023, there's been a massive rise in interest rates because there's this global inflation issue that we're all fighting. So, maybe your deal makes sense at 10% interest, but now we're in a 12% interest environment, and now you're starting to fund the shortfall and you're under pressure because your deal's not working anymore. So that is a big risk that you have to take into account. Collateral risk. If the borrower defaults on a secured loan, the collateral may not fully cover the loan. So let's say that you've got an R1 million loan and you put your car up as collateral and your car is only worth 800,000. So now the bank is going to repossess the car, but there's still 200,000 of the principal amount that they're looking for. What are they going to do? They are going to expect that money from you. So they're going to repossess your car, plus they're going to come after you for the 200,000 Rand. Market risk. This is something that you can't avoid. There's fluctuations, economic good times, economic bad times, and that obviously has an impact on inflation, on interest rates, on GDP, on how good your tenants are and what their stability is in terms of payments. Now, you can't avoid all risk, and you can't just put your money into a bank or hide it under your mattress because, with inflation, your money will erode and you'll lose anyway. So it's not like you can't not invest. You have to invest. It's just about having the right asset allocation where you have a portion of your wealth in growth assets like property, but you also have a portion of your wealth in some more secured asset classes. And then liquidity risks, if you don't have enough liquidity, if you've got R1 million asset and 1.5 million Rand in debt, which means you've overgeared, you're in a very risky position. So I never recommend that you use bad debt, and I never recommend that you overgear. Your asset value should always be greater than what your debt is so that you can cover your debt should you fall into tough times. And then finally, currency risk. Being in South Africa, we have to watch out for this because as our currency continues to erode and we become poorer, debt becomes a little bit less attractive. Now, we've gotten quite a good sense as to what a loan is, what types of loans there are, and what structures are available. But let's look at some specific terms when looking at personal loans or commercial loans and how that'll impact you as an investor. So number one, a personal loan. Let's imagine that you're borrowing 50,000 Rand from a bank to fund home renovations. Your repayment term is going to be short term, probably going to be 1 to maybe 3 years or 36 months. And the interest rate might be 10% per annum. It will depend very much on your risk profile. I recently got a personal loan because we were buying a property and we needed some short-term cash. And I was offered 20% interest. Now, luckily, that was a very short-term loan. We only needed the money for, I think it was 4 months. We refinanced, pulled the money out, and I paid off that expensive debt. So personal loans tend to be very, very expensive. Then we've got a mortgage or a home loan. This is quite low risk to the bank. So you might get a large, value as like R1 million, and your repayment term will be 20 years, which is super attractive, and your interest rate will be comparable to prime. So maybe it'll be 9% interest depending on what the interest rate environment looks like. Then you've got a vehicle loan. Right, vehicle is shorter term, so you're looking at 5 to 7 years, and your interest rate will be relatively high. So in this case, I've just used an example of maybe 12%. Business loan. This is risky for the bank. Remember, the bank can't use your business as collateral. So they're not going to be able to repossess your business to recover their capital. So they're taking a bigger risk. So they might loan you 500,000 Rand to start your micro lending institution. The repayment terms will be short term. So here an example would be 2 years and the interest rate of 15%. And then we've got credit card, right? Now a credit card can be attractive for short-term purchases. So if you're doing like the flipping strategy where you buy a house, renovate, within 6 months you're selling, you can use your credit card to pay the transfer fees, the bond fees, the renovation costs, as long as you know within 6 months' time, once you sell the property, you're going to pay off that expensive debt. But here I've used an example of getting 20,000 Rand limit. You'll get a monthly minimum repayment of 5% of the outstanding balance, and your interest rate will be 20%. It will be very high, very, very, very expensive. Let's end with some key takeaways about loans. Number one, a loan is literally just someone lending you money with certain terms and conditions, and there's a principal amount, what you're lending, and then the interest amount, which is what the benefit is to the borrower. The terms of the loan is always discussed and agreed between the two parties before the money is let out. Loans come in various different types of forms. You've got secured and unsecured, personal, commercial, and depending on the type of loan and the risk to the borrower, certain terms and conditions will apply. Obviously, the riskier it is for the bank, the higher the interest rate or the lower the repayment term will be. They obviously have to mitigate their risk by making sure it's attractive for them. You can use revolving loans to continually access more money or access facilities, and you're also able to refinance properties. As long as you've got collateral, you can get secured lending. Property is a great business because you can use other people's money to make it work. But remember, there is a massive difference between good debt and bad debt. Good debt is using other people's money to buy income generating assets, and the income from those assets are able to fund the debt. If that is not the case and you're having to put money in to service the debt from your own salary, that's an example of bad debt. Bad debt is using other people's money to buy things you can't afford to impress people you don't even like. That doesn't make enough income. So the classic example is to use debt to go and buy a nice, fancy, brand new Mercedes-Benz or nice car. It's lovely for your ego, but it's doing nothing for your finances. Make sure that whenever you're considering debt, whether it's personal, commercial, through private finance, through the bank, it doesn't matter. Make sure that you understand how to use debt, because debt is just money. And if you use debt poorly, if you use debt to go and buy liabilities like cars, you're going to get into a financial hole. But if you use debt wisely, if you know how to use money well, you can use debt to buy assets and generate incredible wealth. I hope you enjoyed that video. Give it a thumbs up if you did. Please go and check out my YouTube membership. You get access to exclusive content. I'll also analyze live deals on your behalf. So go check out my YouTube membership for that and so much more.